let's get into a real life example. This is a property that me and my team wholesaled to a real estate investor here in London, Ontario. Now, we had tied it up under contract for $200,000. We had a $15,000 wholesale fee or a $15,000 assignment, which means the investor is going to be $215,000 total into the property. 15,000 rentals, 5,000 closing costs, going to bring us to about $235,000 total for this investment on this property. Now, this last line, certain investors will like an idea of a capital reserve fund. Other investors don't include capital reserve funds. In this case, I just want to include it so that all the haters in the comment section would have to find something different to hate on for this video. Our rule of thumb here was actually a little bit too conservative compared to the actual numbers. That's a good thing though. So we initially estimated $100 a month in cash flow, but once we've ran all our numbers, we've really figured out that it's actually $430 a month. Want to learn how to analyze a property for cash flow potential in under 10 seconds? Then you need the 1% rule.
Wait, did he just say 10 seconds or less? That's faster than I can put my pants on. 1% rule.
In order to succeed as a real estate investor, it's extremely important that we can quickly analyze real estate opportunities. One of my favorite ways to initially analyze a real estate deal is using the 1% rule in conjunction with the 50% expense ratio rule. Now, we're going to dive all into that in today's video, and we're going to show you exactly how you can go about analyzing a rental property in under 10 seconds. Welcome to part 2 of a 3-part video series on the 1% rule. The 1% rule is a very powerful rule of thumb that we can use as real estate investors in order to quickly analyze a deal or a potential opportunity. Now, in part 1 of this video series, we really just discussed the theoretical concepts behind it and how when we take the 1% rule and pair it with the 50% expense ratio rule, that we can analyze a property quickly, often in under 10 seconds, in order to determine whether it's likely to cash flow or not. This is really powerful for us investors because in order to get a great deal, in order to find a great opportunity, often we're going to need to look and analyze tens, if not hundreds of deals in order to find the best deals. Now, if you spend hours in order to quickly analyze a deal, 1, that's not quickly, and 2, it's going to take you forever to analyze 100+ deals. But if you use the 1% rule and pair it with the 50% expense ratio rule, then we can quickly analyze multiple opportunities in just minutes rather than breaking out a giant spreadsheet. In today's video, I'm going to break down for you that real life example, and we're also going to discuss the implications with the 1% rule. You know, how can we increase the value of a property now that we've discovered and understand the 1% rule? Okay, I've got the real life example here, but before we dive into it, let's just review what we covered in the previous video in episode 1. So we covered the 1% rule, broke down a couple of different ways to look at it. We also talked about how, as a gross rent multiplier, to meet the 1% rule, we're going to want our GRM to be 100. Then we kind of broke down some theoretical examples for you guys, got a little bit more specific when we added in the 50% expense rule, and then made an assumption of an 80% loan to value. Again, if we're going too fast here, don't panic. There's an episode 1 to this video series, so I recommend you check it out. Then we also discussed, you know, what about the expenses? What about utilities? Are utilities included? And I said that in my opinion, you can do the 1% rule if you, the landlord, are paying utilities, and the tenant, if the tenant's paying utilities, we can actually go to a 0.8 or 0.9 rule. So let's get into a real life example. This is a property that me and my team wholesaled to a real estate investor here in London, Ontario. Now, we had tied it up under contract for $200,000. We had a $15,000 wholesale fee or a $15,000 assignment, which means the investor is going to be $215,000 total into the property. Now, this property did need some renovations, estimated at about $15,000. It was a duplex here in London, so it just needed a lot of lipstick. So we're talking painting, maybe changing the flooring, a little bit of drywall repair, nothing major, nothing critical. Then in order to close on the property, you're going to pay things like land transfer tax, you're going to have to pay your legal expenses, and a few other things. So in total, 15,000 rentals, 5,000 closing costs, going to bring us to about $235,000 total for this investment on this property. Now, if we apply the rules that we learned in video 1 of this series, we know that, again, the assumption here is this property can rent for $2,200 a month. I know the market really well. Right now, the property is vacant, which is actually an upside for an investor, but I trust that it can rent out for $1,100 per unit in this neighborhood in London, Ontario. Now, if we apply the 50% rule, the 50% expense rule, I should say, that means we're going to assume that we're going to have $1,100 a month in monthly expenses related to this property, and again, that's just 50% of our gross rent. Now, for the mortgage, what I've done here is he's $235,000 total into it, so if I assume $240,000, let's say, that would work out to an 80% loan to value of $200,000. Now, in this case, based upon kind of the interest rates we're seeing in London, Ontario, at a 3.5% interest rate, 25-year amortization, we're going to be about $1,000 a month for that $200,000 mortgage, which means our rough estimates show that this property does cash flow, not a lot of money, but it shows as if it cash flows $100. Now, this is applying our rules of thumb. This is great for quick analysis. If we want to analyze this property in, say, 10 seconds, this is the way to do it. But what I've got here for you guys is actually all the real life numbers, so we can compare how the theoretical 1% rule and 50% expense ratio rule compares to a real life deal. So again, we've got the exact same rent here of $2,200 a month. Utilities, now the current owner told us utilities were $215 a month. Usually when dealing with seller costs, with seller estimates, I like to add a little bit of a buffer there. So I actually put it up to $250. So in theory, it could be a little bit less, but to be safe, I want to count on $250. Now, insurance for a duplex in London of this size, of this value, be about $60, maybe $70 total a month for insurance costs. Now, property taxes, around $150 a month for this property. Property management expense, now each investor is going to have their own ideas and perspectives on the next set of expenses, and not every analysis necessarily will include these. It really depends on your business model and how you like to structure your spreadsheets. What I've done here is, though, assumed on the high end of the scale that he's going to have 10% property management. In general, property management should be somewhere between 5 and 10%, maybe 12% on the really high end of the range. And if you've got large multifamily properties like Casey Wong does, you're probably going to be closer to a 3 to 5% property management fee. Then we've put in a vacancy allowance of 5%. So what we're doing is the property management fee here, that's 10% of our gross rents. The vacancy assumption is 5% of our gross rents. Now, in the market that we're talking about, London, Ontario, we're actually only have a 2% vacancy rate. So again, this actually has a decent safety of margin here for us. Now, we've added another 5% in just monthly repairs and maintenance. These are small things like, you know, changing a toilet or changing a tap, changing a faucet, things of that nature, changing a door handle, you know, just small general repairs. Because we've already gone into this property and quickly lipsticked it, our expectation is that repairs and maintenance shouldn't be super high in the first few years of operations. Now, this last line, certain investors will like an idea of a capital reserve fund. Other investors don't include capital reserve funds. Really depends on your exact business model and how you like to run your spreadsheets. In this case, I just want to include it so that all the haters in the comments section would have to find something different to hate on for this video. So once we add up all these expenses, we're still left with $1,190 a month in income. Now we need to apply our mortgage. So again, looking at the real life example, he's actually buying the property for $200,000. and the wholesale fee, the renos, and the closing costs, those are actually going to have to come out of pocket because his bank, his financer, isn't going to let him finance these costs. So if I take a $200,000 property purchase and I apply the 80% loan to value, remember LTV stands for loan to value when we're talking about mortgages, we're going to end up with a $160,000 mortgage. Now if we assume a 3% interest rate, which is what investors currently are able to achieve here in London, and a 25-year amortization period, pretty standard. Usually investors in Canada are going to be looking at a 20 to a 30-year amortization schedule. Then we're going to be at a $760 approximately monthly mortgage payment. So once we take the $1,190 we have after paying all of our expenses, subtract the $760 from the mortgage, then we're left with $430 in net real cash flow. So again, let's compare this quickly. Our rule of thumb here was actually a little bit too conservative compared to the actual numbers. That's a good thing though. When it comes to rules of thumb and quick analysis, if anything, we're going to want to err on the side of caution, err on the side of conservatism in order to be safe. So we initially estimated $100 a month in cash flow, but once we've ran all our numbers, we've really figured out that it's actually $430 a month. It's a big difference. That $100 a month is going to take you, 10 of these properties to build up to $1,000 a month in passive cash flow, whereas here, we're really just going to need 2, maybe 2.5 properties. So that's why it's extremely important as investors that we first apply the initial rules of thumb when we're doing our quick analysis. Then when we find something that's close to the 1% rule, when we find something that we think could cash flow, then it's extremely important we dive deep into the numbers and really figure out all the details, because like they say, the devil is in the details when it comes to real estate investing. That's it for this real life example, but where else can we take this information, or how else can we use the 1% rule to make us more effective, more efficient, and just better landlords and real estate investors in general? Well, now that we've kind of broken down how the 1% rule works, let's look how else we can use it, or how else we can apply it to our real estate investing approach, to our real estate investing strategy. So what I've written down here is, let's take a 1-bed, 1-bath unit. Doesn't really matter whether this is in a single family home, so the entire house is this, or whether it's in a 100-unit apartment building, the principle applies regardless. That $900 a month at the 1% rule means we should be willing to pay approximately $90,000 for that unit if this is the only metric that we're using to analyze a deal. Now, let's say that this 1-bed, 1-bath was in the duplex I just showed you guys. Now, if we can take the 1-bed, 1-bath and convert it to, say, a 2-bed, 1-bath, whether that be by adding an addition, or converting a basement into a bedroom, or converting a dining room or a second living room into a bedroom, and let's say that tenants in our market will pay more. I know in London, Ontario, a 2-bedroom apartment, even with the exact same square footage as a 1-bedroom apartment, that 2-bedroom will always rent for more money. So in this scenario, let's say instead of $900 a month for the 1-bedroom apartment, we could actually get $1,200 a month for the 2-bedroom apartment. Well, again, applying the 1% rule, we end up with a valuation of $120,000. Let that sink in. We literally created $30,000 in value, $30,000 in equity by maybe just converting an existing space like a dining room or an unused basement into another bedroom, which allowed us to rent the property for more money. That created $30,000 in value. Now, if you're converting a dining room over to a bedroom, your real costs are nowhere near $30,000. You're probably slapping up a wall or two, maybe you're putting in a light fixture, maybe you're adding a door or two, maybe you're adding a closet. We're talking maybe $500, $1,000, $2,000, $3,000 tops for that type of renovation, but we've created $30,000 in equity. Now the same thing applies even if we're not converting bedrooms, but we're just providing better amenities. So way back in the day on my YouTube channel, my very first video series, I talked to you guys about the value of strategic renovations. So what I love to do is install dishwashers into units where dishwashers currently aren't existing. I love to add laundry to units that didn't previously have laundry. In my market, for a dishwasher and a nice clean looking kitchen, I can probably charge another $50 a month in gross rents. Again, applying that 1% rule, that means that the property value has increased by $5,000 by adding a dishwasher. So in essence, if I can have that cost of installing the dishwasher and buying the dishwasher be less than $5,000, then it could make a lot of sense for me to execute on that strategic renovation. Same thing goes for that laundry unit. I can often charge $100 more a month if I add laundry to an existing unit. That's added $10,000 in value to the property. There's just so many ways we can take and apply this. Let's say you're looking at that single family bungalow that currently rents out for $1,500 a month, but you could convert the basement into its own apartment and rent both for $1,000 a month. Well, because we've increased the gross rents by $500 a month, we've now added $50,000 in value to that property. This is a massive investment strategy. It's a massive way to create forced appreciation, and what it comes down to is really you becoming an expert in your market, in your city or region, and understanding what causes tenants to pay more for a property, what amenities, what utilities, what sort of situation will they pay more money for in order to get that benefit. If there's opportunities here as a real estate investor, if we want to create that second investment strategy that we talked about in video number 1, the forced appreciation, that's where this really comes into play. Executing on these strategic renovations, adding dishwashers, adding laundry, creating bedrooms, adding bedrooms, finishing basements, all of that stuff can dramatically add dollars to our bottom line. That's it for this video, guys. I hope you enjoyed it. If you got value from this real life example of a 1% rule property, smash that like button, hit the subscribe button if you're new to my channel, and reminder, this is part 2 of a 3-part video series. So hit that notification bell to make sure you see episode 3. In video 3, we're going to break down some of the pitfalls and some of the problems when it comes to the 1% rule and other things we need to keep an eye out for. As well, we're going to discuss what you need to do next when you find that 1% rule property.